welcome to my channel. Yes, you guys are in for a really great treat. Today I'm gonna build the most, or what I meant to say is I created the ultimate credit guidelines for basic people wanting to learn about credit.
Yeah, boy.
So go ahead and stay tuned, and towards the end I'm gonna show you a credit map that I created for people that are new to credit or maybe wanting to rebuild credit. This can work for either or of the spectrum, and you'll find out here towards the end of the video. And before I go ahead and also start, if you want to book a consultation with me, I'll put it in the link description below, or you'll see something here on the screen. Either one of those, that's where you can go ahead and book me, and we can go ahead and help you get started on your credit. So let's go ahead and start with the further ado. Okay. Alright, here it is. Credit 101 for everybody. Let's go ahead and get started. Alright, what is credit recovery? Credit recovery is an organization dedicated to helping people establish or reestablish credit by providing diverse credit information, industry secrets, and decade of experience approving houses, autos, boats, personal loans, jet skis, all those type of fun loans for everyday Americans like yourself. So here's a couple of my credentials. Credit counselor, certification for mortgage underwriting, another mortgage underwriting certification, another one, and where I've worked at as a consumer loan underwriter, because again, I'm a person that approves loans for a living, so I know exactly what these lenders are looking for. So here's another place, here's another place, and here's the last one. I have many more, so just wanted to go ahead and let you know the credentials. So this is what you're going to be learning about, the ultimate guide. So we're going to go ahead and be understanding credit reports, building credit scores and loans, protecting your credit score, which is important, some financial terms for you to know about credit, some laws, and then some facts and myths. Let's go ahead and get started. All right, so understanding your credit report. All right, so pretty much a credit report is a detailed history of your credit history, your payment history, and your outstanding debts and other information, which we'll talk more about that. We have your credit history, which pretty much is how you've managed to go ahead and pay your credits throughout the last 7 years, because that's all that reports on your credit report. So how, if you missed any payments, when it was opened, when it was paid off, what was the balance that it started with, have you ever missed any payments, or did you actually pay perfectly? So those are the type of things you'll see on your credit history for the loans. And then you have your outstanding balance right here, which pretty much the balances that you owe, really nothing deep to it. All right, your payment history. This is, I'm going to go ahead and say it is an important thing out of your credit. So making sure that you always pay your loans on time. That counts for a majority of your credit score, which I'll talk about more further as we get along. But go ahead and remember that. So yes, so making sure you get your always paying your loans on time will always make sure you have the highest credit score. Then you have your other info that I was referring to, so that's anything like your personal information, like your names, your addresses, date of birth, place of employment that you've used whenever you've applied for loans. Okay, how to get a free copy of your credit report. You can go to get a free copy at annualcreditreport.com, or what I recommend, going through Experian.com, where you can actually just pay, get all three, and have access to additional resources. So so these are the three major credit bureaus. You have Experian, Equifax, TransUnion. A nice little tip for you guys: lenders use Experian. That is the most used on when it comes to approving loans, so making sure you always, that's why I say get Experian for that reason. And then TransUnion is the second one used, and then Equifax is last. Alright, remember how I talked about payment history? This will, out of the 100% pie, payment history is your most important one. It counts for 35%. So when I told you it was the most important, I was not kidding. That's why you can't miss your payment. I cannot stress this enough, people. And the next one is going to go ahead and be amounts owed. So making sure you're not too much into debt will go ahead and make sure to have a high credit score. Then you have your credit history. How long do you have credit? Credit mix. Do you have installments and revolving loans? And then you have new credit. So these are new loans that you add to your credit history. And if you have any questions, please put them in the comments. I'm here to help you. That's what this channel is for, to help you to build your credit or reestablish your credit and give you those inside secrets. So make sure to put your comments. And if you haven't liked and you haven't subscribed, stop playing with me. Subscribe. Alright, let's get back to this. Alright, so now we have credit utilization. This is a great way of how to one of the ways to build your credit utilization. So you never want to make sure you exceed more than 30% of your credit card limits. So essentially what that pretty much means that so they will drop your score if you exceed a certain amount. This is like a unwritten rule. Like this is something that's already available, but not something that is like told to you by the credit bureaus, like I mentioned, Experian, Equifax, and TransUnion. So this is something you do need to be aware of. So over here, make sure you don't exceed 30%. And how do you do that is pretty much by adding up all your credit limits, whether it's 1 credit card, 3 credit cards, or 10 credit cards. Once you add them up, here's a nice example. You have 10,000 times 30%, which equals 3,000, and that's all that you have to go ahead and do to find. So if you have $1,000 of a credit limit, that would be 300. If you have 100,000, that would be 30,000, etc., etc. So to optimize for the best credit score, you want to be at 10%. That's another unwritten rule that is out there that is very effective. How do I know that? I've seen a lot of credit reports when I'm reviewing loans, and whenever I see where they're at the highest credit score, it's because they have a low credit utilization. That is the reason why. So making sure that you have a low credit utilization will help. And then you have amounts owed, which is again the second biggest factor when it comes to your credit. I always like to say never be more than 15% of your income in debt. For example, so if you make 50,000, 15% would be 7,500. I know, I get it, but I'm helping you. I'm making sure you're out of debt and you have more money in your pocket, because again, that is how you build your financial. That's how you build your financial wealth, is by having money and being able to invest it in different ways. So if you're in debt all the time, that is going to affect you really bad. So that's what I recommend, 15%. So, all right, moving on to the next. Here's payment history again. Again, can't stress it enough how important it is. All right, let's see if you guys have been paying attention. You guys better have been paying attention. I put my blood, sweat, and tears into this. Okay. Maybe exaggerating, but
Brother, this guy stinks!
Essentially, yes. I want to make sure you guys are understanding. So here's a couple little questions for you guys. Alright, so the first one's going to go ahead and be, name one of the credit bureaus. Next, what counts for the highest percentage of your credit score? And then what website can you get a free credit report from? You cannot go back. I am watching you. I'm watching you. I'm going to know what is the most replayed. So, watching. Alright. Go ahead and answer that there at the bottom. Alright. Credit score and loans. Alright. So, essentially, there are two credit score types of models. So you have FICO and Vantage. FICO is the one that's used by all lenders. This one's still new and is being slowly developed. Pretty much what is FICO? FICO is credit score is a 3-digit number that represents an individual's credit worthiness and based on a credit history. The FICO score ranges anywhere from 300 to 850, which the higher, the better. With Advantage Score, it's the same thing. It was created by all three major credit bureaus, but the difference is they use different indications to go ahead and determine what your credit score is, which you'll go ahead and see here in the next slide. All right, here's a perfect example of that. So remember how I talked about the algorithm, the payment history? It's now, if you look at Advantage, they account 41% for your payment history. They combined the age and the mix of your credit history, which is pretty much your credit history and your credit mix combined. Your credit utilization, which accounts for 20%, new loans that you put on your credit history, your balance of 6%, and then available credit 2%. So that's how Vantage Score. And if you want to know where to go find this, this is going to go ahead and be whenever you enroll into Credit Karma. They show you Equifax and TransUnion. Unfortunately, they do not show you Experian, which is really annoying, but at least you have access to those two. And then whenever you enroll into it through your bank or financial institution, because that's a huge thing, having to give you credit monitoring, that's something to take advantage so you can see your Vantage Score. And then again, they are also using they're using Equifax and TransUnion, or sometimes just one. There's not a lot that really use Experian. All right, so to indicate to you that the most used is Experian, this is from a credit report that I have seen personally myself, and this is what we see on our end. So as you can see here, it says Equifax, FICO, TransUnion, FICO, Experian, FICO, and as you can see, there's no Vantage Score being used at this time. Doesn't mean it can't change in the future. Okay, how to find your true credit score. So this is something that a lot of people do not know how to show people, and you're gonna get that exclusive from me. I'm out here teaching you guys. Let's go. Okay, so first you're gonna want to go ahead and sign up to Experian.com, which hence is the reason why I would suggest having an Experian account. So once you sign up, you're gonna go ahead and sign in. You're gonna hit credit. From there, you're gonna hit credit overview. It's gonna take you to another page. Once you're there, you're gonna scroll all the way down until you say additional FICO scores. You're gonna see this information. The only way to see this information is if you are paying the highest, if you're paying the subscription. That's the only way for you to see this information. If you don't, it's going to lock it. That's the frustrating part. So I do recommend it. I check mines every 6 months just to see where I am at before I apply, and it's a really great tool to use before you apply in general. So keep that in mind. Okay, so if we go back, so as you can see, if we go over here, how it shows FICO Score 2, I'm going to show you where it shows it on ours end, so you can be able to make that connection. So you see how it says Experian Fair version 2. See, just like how I just showed you. So that's how you know the information I'm telling you is accurate. This is pretty much what we see, and this is also whenever you are talking with a lender, they're saying, hey, my FICO score shows 800. Well, we see 770 on our end. It's because of those different FICO score models that they use, which you'll learn more in the upcoming slides. All right, this is the algorithm again. Take a screenshot, write it down.
I don't give a fuck.
Yeah. Mortgages, and for mortgages they use FICO Score 2 we established. For credit cards they use Bank Card 2 and 3 and 8. For auto loans they use FICO Score 2 and 8. So take a screenshot of this so you can remember. So again, when you're talking to the lenders, you understand why the credit score they're seeing is different. Okay, here's another test. You thought the tests were over? Stop playing with me. I gotta make sure you guys are paying attention. Let's go. Alright, so these are the nice little fun questions. We have, what credit score models do mortgages and home loans use? Which credit score algorithm do lenders use to approve you for a loan? And the last one is, what website and requirement is needed to access credit scores used by the lenders? Do not fail me. Do not fail me. Stop playing with me. And go ahead and put the comments below. I gotta see if you guys answer these. Alright, let's get into loans. Alright, so here's an installment loan, which I mentioned in the earlier. So what pretty much is an installment loan is a loan that pretty much has a beginning and it has a end. It is, to me, in my opinion, the best one to use. So what are types of installment loans? So you have your auto loans, your mortgages, your personal loan, your student loans, buy here, pay later. Other ones that I didn't include would be RVs, motorcycles, jet skis. Those are all also installment loans. Those are loans that you pay a consistent amount each month and it never changes. It's just the balance that decreases. Alright, what is an open-ended loan? That would be the opposite. So these are loans that do not close unless, that is key, unless you decide to close it, or the lender decides to close it because you're delinquent or sees a drop in your credit score by a dramatic amount. So if they see their credit score is dipped really low, they will close it. I've been part of a team that would actually do that, so I can admit firsthand they will close it on you if your credit score takes a huge dip. Alright, either way, if you're wanting to increase your credit score, whether you're new to credit or not, the most important one is installment because it shows credit history to lenders. They want to see consistency because what can happen is essentially you can have a credit card and charge it all the way up to the max, and then pay it off next month or take a couple of months to pay it off. But then once after that, there's no more payments that are being reported, which again, payment history is the biggest factor of your credit score. So that's why an installment loan is the best. Is it starting to make sense now, my people? Come on. Okay, moving on. Ha! More questions. Let's go.
Oh, God, please, no! No!
What is an installment loan? What is an open-ended loan? Which type of loans is the best to build your credit with? We talked about it. Lock in, baby, lock in. Alright, now this is the way to protect your credit score. These are the services that are available, which we're going to go over here some now. So you have your credit freeze, which pretty much limits access to your credit. This is something you have to set up through each credit bureau individually, so through Equifax, Experian, and TransUnion. What this is it won't allow people to see what's on your credit, which is very important when it comes to lenders looking at your credit report. They want to be able to see, oh, what's on there. And if you have it frozen, which is great, you just have to remember to unfreeze it, and it's a great way to protect yourself from fraud. So people opening up accounts and things of that nature. So I always say to have a credit freeze for that reason. And then you have another tool, which is disputes. How do you dispute? Which I'll go into a video next time, but this is something you can do. So anything that's inaccurate or an error, you can go ahead and fix it. So let's see if you paid off a loan, but it wasn't reported. Let's see if you know you made your payment on time and you have proof. That's another reason. Let's see if they have your name wrong, your address wrong. That's information that you can go ahead and dispute to get it fixed. Disputing can help increase your credit only based off negative things that weren't truly your fault. So if you really did miss payments, then that's on you. They won't delete that, even though other people say otherwise. The next one is going to be fraud alert. I think this is something that should be just available to people in general. So before you open up a loan, if you ever gone through fraud that people have taken loans out in your name or anything of that nature, essentially what this does, it allows you to put it on a phone number, and that phone number will lenders are required to call you before they approve your loan. If they don't, they're violating the law, which I'll show you which law that violates. So making sure, again, if you go through fraud alert or have been through it, set that up. It will come in clutch for you guys. Okay, this one's credit monitoring, which again, this is a very great way to also boost your credit and to be on top of what is happening on your credit. So we have things like it'll report to you when there's a new inquiry, when your credit score increases, decreases, new accounts open, any information that changes, any personal information that changes, they alert you. So that's a really great tool to honestly have. And then again, financial institutions provide this information, so you'll have multiple sources. All right, more tests. Let's go. Name one service that you can use to protect your credit. Which credit protection is the best? Which credit protection can help you increase your credit score? So go ahead and put them down in the comments. I need you guys answering to see if you guys are understanding. Help me, help you, help us. Come on. All right, let's get into some intro credit terms. So these are going to be broken down into 3 sections. We're going to have general credit terms that have to do with your credit history, auto terms, and mortgages. Let's go ahead and get started. All right, so here's credit. So credit is pretty much money borrowed that you will pay back in full at an agreed time that may or may not include interest. What is a credit bureau? It's pretty much an organization that collects and maintains your financial information. So that would be, again, Experian, Equifax, and TransUnion. Then we have your credit score, which is pretty much generated from your credit history for how you have made your payments, your outstanding debts, and other financial information like collections, bankruptcy, etc. And again, they give you a number from 300 to 850 for Experian. What is a FICO score? It is an algorithm created by Experian to assign you a credit score between 0 to 850. It uses payment histories, amounts owed, length of credit, new credit, inquiries, along with other financial data to determine your FICO score. So remember how I kept showing you that pie graph? That's pretty much it. Remember that. Next, what is a consumer credit file? Consumer credit file is just another word for a credit report, which shows your name, address, social security number, date of birth, and other public information. You have the creditors, which is pretty much a lender or someone that you have a loan through. So it won't. Sometimes it may not be a bank or a credit union or a financial institution. If you're financing furniture, they're also considered a lender. If you are financing tools, I know there's a company called Mako Tools where you can finance tools. Snap Finance, they're also a lender because they're letting you borrow money in order to pay for whatever you're trying to finance. So that stuff gets reported, not all the time. So I would definitely check to make sure that you ask them, hey, does this get reported to my credit report? And to say yes, then you already know what to do. Okay, going back to it, credit obligation, which is pretty much an agreement which a person is legally bound to pay back borrowed money. All right, credit history, it's pretty much how consumers has repaid their credit obligations in the past. It'll also show the summary of how you paid your loans, if you missed any payments, new loans open, what kind of loans, bankruptcies, etc. You have a line of credit, which is a form of revolving credit whereby the borrower can draw only the amount needed up to the credit limit. The borrower only pays interest on the amount drawn or dispersed, which that is different between a credit card. A credit card, pretty much, you can't pull money out. That's the difference between a credit card and a line of credit. With a line of credit, you can pull money out, and they'll give you sometimes checks where you can write and purchase things. So that's pretty much the difference between the two. Revolving debt is pretty much debt owed on an account that the borrower can repeatedly use and pay back without having to reapply. So this is pretty much referring to a credit card. And then installment debt is to be paid on a regular time over a specified period. So that would be anything like, again, like an auto loan, mortgages, boats, jet skis, etc. Late payments, we know what late payments are. Defaults. So defaults are pretty much when you're 30-day past due back to back. Delinquency is when you're past due, but you still don't pay. So it goes from 30 to 60 to 90. So the difference between the two is that you can pay late and be 30 days past due, and then pay it and then go another 30 days past due. That would be more of a default. A delinquency is when you're continuously not paying throughout the months. A charge-off is pretty much a balance on a credit obligation that a lender no longer expects to be paid. So that's when they send it to the collection agency. So that's when you know when it's a charge-off. Collection is pretty much a collection agency. They're trying to, collect on that. You have inquiries, which pretty much is a consumer credit report that shows someone is trying to access your credit report. There are certain laws under the FCRA when they can and cannot. Interest rate is an amount charge expressed as a percentage of principal. APR is the real cost you pay to borrow, as stated on the yearly percentage of the loan amount. So the interest rate is what the finance company is going to charge you. The APR is going to include not just the amount you borrowed, but also if there's any fees, any closing costs. That is what's going to go ahead and show you what your APR and why there is a difference. One is just only to borrow money. The other one is to include all the other finances, additional finances, besides of what you asked. Understand it, it's okay. Put it in the comments below. That's why I'm here to help you. Let's move on. We have loans, which is pretty much you borrowing money and expect to pay back with interest or sometimes no interest. Bankruptcy is pretty much when the government allows you to not repay debts, but that stays on your credit report for 10 years. That affects you when it comes to loans. Alright, let's jump into the auto loan terminology. We have a pre-qualification. There are the first two steps in applying for a mortgage loan. First is a lender or a broker that pre-qualifies you. Pretty much the pre-qualification determines whether you have the financial resources to match the size of the loan you're requesting. The information is not often verified at this step. It is a preliminary step to the screen viability as a loan applicant. So this is pretty much the pre-qualification step is pretty much when you just apply. And then if they just approve you, they're just approving you based off the information you provided. So the next one is pre-approval. Requires much more detail. This is where you're going to need to verify your income, down payments if applicable, and other financial information. That meets the underwriting guideline, that is a person like me that is reviewing. And then that will go ahead and indicate if you're truly approved for what you asked for. An approval is pretty much an acceptance document with info regarding the loan amount, interest rate, term, monthly payment you have been given for the loan. So if you asked for $10,000, you got $10,000, then you got approved for you to talk about for what you applied for. Now we have a counter offer. Counter offer is when the lender states that they couldn't approve you for the $10,000, but they'll give you $9,000. And then again, it'll have the same information as the approval, like the interest rate, terms, monthly payment, etc. We have a decline. We know what a decline is. That's when they decline your loan regardless of what you're asking for and not even a counter. And then we went over what interest rate is, debt to income ratio. This is something dealerships and loan officers will talk to you about. Pretty much it combines your monthly debts divided by your gross month income. So an example is, let's say if on your credit you're paying $1,000 towards your debts because you have credit cards, auto loans, and other types of loans. Let's say if you make $2,000 a month, if you divide 1,000 by 2,000, that gives you 50%. You never want to be that high. That's really bad. Lenders look at that so bad. So you want to be around a debt to income between 30-40% is pushing it. And now we have a prepayment, an amount that you may pay on your mortgage or other loans like an auto loan that constitutes an additional unscheduled payment. So this is when you pretty much make your extra payments. A down payment, obviously that is amount that you state whenever you go to a dealership or say, hey, I'm going to put down a down payment. Everyone knows what that is. A lease contract is pretty much you renting out a type of, is you renting pretty much. So think of it like leasing an auto loan. You're pretty much just renting it. Or if you're doing a rent to own, that's another lease option that you have. Lease terms are pretty much a contract with a lease term, the period that the leasee contracts with the leaser, which that would be you, the leaser, to make lease payments. At the end of the lease, the leasee, which is the lender, have the option to renew the lease for a new term, purchase the auto at the price called, or you can just go ahead and walk away. That's pretty much what a lease term is. And I went ahead and got ahead of myself. But that's essentially what it is. But I'll read this one just for the fun of it. So a auto lease purchase option is an asset that is used to secure repayment of a loan, also called security. For example, if a borrower defaults on the auto loan, the lender has the right to sell the collateral in order to collect the loan. The principle works on most mortgage loans, which collateralized by the home that the loans are used to buy, which is the same thing for autos. Loan to value, so LTV pretty much is a lending risk where the lenders examine before approving you for an auto loan. So essentially what you do is to figure the loan to value, you grab the loan amount divided by the value. So let's say if you're trying to buy a $10,000 car, let's say if you're only wanting to finance $5,000 but the value is $10,000, then if you divide that, that'll be 50%. Equity is pretty much value of ownership built up in a loan, or I guess in an auto in this case, that represents the market value. Vehicle options are pretty much choices that are sold separately for an extra fee when you buy a vehicle. So this can be like when the dealership tries to sell you the add-ons like nitro tires or tinted windows and whatever else. When the loan officer or the dealership says blue book value, what this pretty much means is a phrase that gets its name from Kelley Blue Book, which is pretty much a company that is a source for giving car values. So they'll determine based off new and used. So that's pretty much what Blue Book uses. It's the one that is the most used. Right? Your trade-in. So when they mention trade-in, it's either an auto or another vehicle in exchange when you buy a new one. A trade-in value is the price they're going to give you for that vehicle or other items such as like a motorcycle, an RV, or a boat. An invoice is sometimes referred to as the dealer cost. It's the price that appears on the invoice that the manufacturer sends to the dealer. So that's pretty much what the dealership paid. A buyer's order is a document that is a purchase from a dealership that is often called a bill of sale. Pretty much has the information of the vehicle, so the VIN number, the year, the make, the model, etc. If you're going to purchase any gap, extended warranty, that's pretty much what's on the buyer's order. A purchase agreement is to finalize a sale. These contracts serve as a sales agreement between the buyer and the seller. So when you're buying from a individual, you'll go ahead and also run into this. That'll be a purchase agreement. A retail installment agreement, that is a document that details the terms of the financing you must secure in order to get the car. If you are getting a loan yourself from a third party lender, such as a bank or a credit union, that lender will make the credit decision, not the dealership. So, whenever you're financing through the dealership, it is not them deciding, it is the lender that they send it to. Loan closing. This is pretty much when it is mentioned to you the final stages of the loan process that requires an exchange of money and signatures in order to go ahead and close on the loan and solidify the purchase agreement or retail installment agreement. Bill of sale is when you buy from a private party, like on Facebook, Marketplace, maybe Craigslist, and other those. They're similar to the to the dealerships where they'll have the vehicle information. All right, a title. So when the title is mentioned, it's pretty much the title of the car is a legal document providing proof of ownership. A lien is a legal claim held by a creditor against the asset. So whenever they say, hey, we need to put the lien on the vehicle, that's to protect the lenders. So when they, in case if you stop paying, which you shouldn't, if you're trying to build a credit or have a high credit, then they can just repo the vehicle and be able to sell it because they have authority for it. Let's get into some nice mortgage terminologies. Closing. Closing is similar to the one from the auto, so pretty much not going to go through that. Closing costs is the total expenses that the buyer is going to pay at the real estate transaction. So your application fees, underwriting fees, loan origination, taxes, and any other fees. Conforming mortgage loan. When this is mentioned to you, a mortgage loan is an amount allows Freddie and Fannie, two government-sponsored enterprises, to buy the loan. So this is pretty much a conventional loan. This is all pretty much what it is. So these are one of the two institutions that will buy those loans. We already know what an APR is, so moving forward, debt to income, we know what that is, down payment, conforming mortgage loan, which that's in there twice, equity, we went over equity in the auto, escrow account. So when escrow is mentioned to you, it's a reserve account controlled by a fiduciary agent that is used to make regular homeowners insurance and real estate tax payments. So that's pretty much whenever you don't put 20% down on a mortgage, they will make you pay that. So just to let you know. Home equity is pretty much like equity, so won't need to go over that. Home equity loan, by though, is different. So it's an amortizing mortgage loan that allows homeowners to borrow against the equity of the home. Normally people use this to home improvements, consolidate debt, or for other general purposes like maybe going on vacation or weddings. Home insurance, that's pretty much just insurance for the home that's required when you have a mortgage. Interest rate, we talked about it. Liens, loan closing, loan to value, same thing applies for mortgages. What the value, how much you're purchasing divided by how much it is worth. Origination fees. This lender may change this to pretty much a fee pretty much for doing the loan with them. That's pretty much what it is. P&I, payment and interest, is pretty much how much you're paying towards the principal and the interest when you have a mortgage. When you hear the word PITA or PITIA, it's pretty much an acronym for loan, principal, interest, property taxes, homeowners insurance, and association. So the association is like HOA. We went over pre-qualification, pre-approval, prepayment. PMI, whenever you don't have 20% down, you are required to get this. It's an insurance policy that protects the lenders against a loss if the borrower defaults. Typically requires the loan to value to be more than 80%. So look at it this way. So if you're financing a home for $100,000 and you finance it for $81,000, that's 81%. Again, you're gonna do that 81 divided by 100, which you'll go ahead and see that would be 21%. Property taxes, everyone knows what property tax is, but it's not. It's just pretty much an amount they need to pay your county or city to every quarter. Right, sales contracts are pretty much a legally binding document between the buyer and the seller of a home that should address all terms and conditions of the transaction. So it's similar to a purchase agreement, but more for a home. Title insurance. Title insurance policy that the borrower buys when closing a mortgage loan to ensure that the title that the property is secured has no surprises. A title search shows any legal encumbrances on the parcel used as a collateral, but on occasion an unrecorded lien might exist. This would jeopardize the lender's collateral position. Thus, the lender requires title insurance policy. So this would be more if they found out that there was another lien holder through another mortgage company or a lender, and it was just never disclosed on the title. So that's why title insurance would be nice to have. Adjustable rate mortgage, that's an amount that you pay on your mortgage or other loan that constitutes an additional unscheduled payment. So it's just that is not what adjustable rate mortgage is. An adjustable rate mortgage is an adjustable rate mortgage is pretty much an interest where the interest rate changes periodically. It can change. It changes normally year to year is what I've normally seen, or whenever your loan document states it. I'll try to find an example and put it on the screen for you. Amortization. It's pretty much an appraisal. The process of estimating a fair market value of an asset. Appraisals are routinely required for real estate transactions. Let's move on to the next one. We went over appraisal value, market value. So a value of an asset of a certain date. It is the price at which the asset would change hands in a free and arm's length transaction. Market value is also called current value. For example, the market value of your retirement account today may be $100,000. This is the total market value of the stocks, bonds, cash, mutual funds in the account. In case of most securities, market values can be determined every day given a given point in time. How this would look like in a mortgage situation, it would be, let's say if you bought a house today and it was worth $100,000, and then 5 years in the future it was worth $500,000. That's pretty much what market value is. All right, let's go over some laws. With these laws, I'm just gonna read them. Feel free to rewind back on these. Since these are laws and I'm not an attorney, I'm not gonna fully explain. But there's some notes, there's some writing on there about those laws, or you can just do your research. But I'll just go over them really quickly. All right, some laws for you guys. All right, the Truth in Lending Act. Go ahead and take a look, take a screenshot. I don't give a what. Regulation Z. Home Equity Loan Consumer Act, also referred to as HELP A or HELPA, however you want to pronounce it. You have HOPEA, Home Ownership and Equity Protection Act, Fair Credit Report Act, known as FACTA, Dodd-Frank Act, Equal Opportunity Act, known as ECOA, the Credit Repair Organization Act, known as CROA. So this is really good for you. Get familiar with this, because if you're in this position that you need credit repair, understand the laws about it. All right, let's get into some of these credit facts and myths. All right, here's some facts for you. Good credit scores do not necessarily mean your credit application will be approved. That is a fact. Only because you have a good credit score, that is not the only determining factor when it comes to giving a loan. You can still get a loan if you have a bankruptcy. That is a fact. There are actually specific lenders that will approve you if you have an open bankruptcy or going through a Chapter 7. Disputing inaccuracies on your credit report will increase your credit score. That is also a fact. Here's some myths for you. Checking your credit score will decrease your credit score. Nope. This is allowed for you to have. That's the reason why they allow you to sign up and have access to it. Closing a credit card will increase your credit score. It will not do that, especially if you have a zero balance on it. It's not dipping into the amount owed where it starts affecting you, but it does affect your credit history, because if you had a loan for let's say 5 years, and it was a credit card, and your most recent loan that you opened was 3 years ago, and you only have those two loans, if you close it, it's going to go from 5 years to 3 years, and that's where you'll start seeing that dip on your credit score. So that's why you never close credit cards, because of that reason. That's actually the longest way to build your credit long term. All right. If I pay off a debt, any late or missed payments on that account will be removed. No, if you pay it off, that's not how that works. That will remain on your credit report for 7 years. All right, here is your credit roadmap. All right, so this is pretty much going to be for anybody that needs to build credit or rebuild credit. Following this simple process, you will build your credit score. It's going to take a couple of years. It's not something that you can just instantly get like that. So let's get in here. First, if you have access to an authorized user, this is pretty much where someone puts you on a card, but you're not obligated to pay. This is a nice tip to do whenever you're building credit, because it just inflates your score. So anything to help increase it will go ahead and help. Next, you want to get a secured credit card. So you want to start building your own credit again, or establishing your credit. So going to your bank or credit union, or even Capital One, they have secured credit cards where you can put money down pretty much, and once you decide to close it, it will go ahead. They'll give you the money back, and then you can go ahead and get it unsecured where you don't need to put money down. But this is a great way, just because they always have a 90%, I'm going to say 90% and above of being approved, just because it's backed to buy money. The next one is going to go ahead and be, I'm going to change this to installment loan versus auto, but people are normally going to get an auto. But anything, so let's say if you need to get furniture for your home, or maybe you want a motorcycle, or maybe you want a jet ski, that can also fall down to this, not just an auto. So this is what I refer to about the installment loans. Remember, so we're attacking the revolving and then the installment. So we're hitting majority of the credit algorithm that I mentioned throughout the beginning. So you want to make sure you do that. Okay, and if you made it this far, congratulations, you have a solid foundation of how to build credit. Again, if you go ahead and scan this QR code, or again, look in the link in the description to sign up. If you have any questions of how to build your credit, or just wanted to know credit information, put it in the comments below. I got you guys. And go ahead and subscribe if you're new. I'll go ahead and see you guys next time.